Good morning, everyone. It's Monday, February the 16th, and welcome to 7 Investing Live. This is our live stream event where we put the spotlight on several of the stock market most intriguing opportunities. You can learn more about our long-term investing approach at 7investing.com and get started with your first 7 days for absolutely free at 7investing.com/subscribe. My name is Simon Erickson. I'm founder and CEO of 7 Investing. I'm so excited to welcome our guest here today. John Rotonti is a portfolio manager at Bastion Fiduciary. We're going to be talking about software stocks. We're going to be talking about the SaaS apocalypse, and we're going to be talking about opportunities in the industrial and manufacturing sector. John, you and I have known each other for quite a long time. I know I speak on behalf of everyone here when I say welcome to the 7 Investing Live show this morning.
Simon, thank you for having me. Thrilled to be on your show. Big fan of everything you do. And happy Mardi Gras. Actually, today is Lundi Gras. Today's Fat Monday, which is the day before Fat Tuesday.
I was hoping you were going to tell me how things are in New Orleans. Can you tell me 2 seconds just how it's going out there? You know, the Mardi Gras parades. Is it all eventful out there right now, John?
It's eventful. We've had good weather for the most part. It's been great. It's been wild. A lot of parading, a lot of eating, and honestly, a lot of drinking. Just to be honest.
I saw some videos and pictures of my hero Drew Brees throwing beads and footballs off of a Mardi Gras float. So it brought me back some nostalgia right there. I'd love to live vicariously through you in New Orleans there.
He was in the Bacchus parade last night, and I'm wearing my my Mardi Gras colors.
I saw that.
Yeah.
Well, John, let me set the scene for today's show because we've got a variety of topics, and I always love hearing your perspective on this. First of all, I want to talk about software stocks. Software stocks have been having a tough go here in 2026 and 2025 as well. And there's a lot of questions about what's in the future now that AI is kind of a technological disruption. We're also going to talk about industrials a little bit later on the show as well. But to set the scene on this, John, it wasn't that long ago, just a couple of years ago, that software stocks were the high flyers of the stock market, right? It seemed like so many companies were doing that transition really well from on-premise deployments to moving everything to the cloud. There was the opportunity to iterate quickly, to grow quickly, to make a lot of money really quick. But there's been some kind of chinks in the armor, if we might say it, with software companies here recently, including massive amounts of stock-based compensation and extremely egregious valuations. You've been critical of this sector for quite a while, John. I think that you're getting some vindication on this for correctly calling there's some problems with SaaS companies. But tell me kind of, what you think of this sector, where it's been the last couple of years, and kind of where we stand here today.
Thank you for pointing that out, Simon. So I'm not an expert in individual SaaS companies precisely because they've never been high quality enough for me based on the lens that I use and the aperture that I use. Someone else that looks at quality in a different way could see these companies as extremely high quality. But based on the lens that I use, they never met my high quality standards as a whole. Of course, there are a few exceptions, just like everything. And so thank you for pointing out. Yeah, I've never been a fan of the group. And going back as far as 2022, I pointed out some of the issues that I have with enterprise software as a service businesses. The largest and most important, which I still think is an issue today, is I think that the barriers to entry are very low or almost non-existent. And I think that the moats are very narrow or non-existent in many cases. And as I pointed out let me take a step back. And because of this, there's a lot of competition, Simon. There's a lot of competition. It's very relatively easy to start a business selling software as a service. And so there's a lot of shots on goal. And there's always the risk, in my opinion, once again, of technological disruption and obsolescence. And AI is the latest example of this technological disruption that could potentially harm some SaaS businesses. Of course, others will adapt quickly and adopt AI in a way and agents in a way that even allow these companies not only to survive, but thrive. So there are some instances like that. But yeah, I would just say that, and then, so in addition to the what I see as no barriers to entry and no moats. I don't like the cultures. I don't like the corporate governance. I think that the stock-based compensation is egregious. I think it's a weak way to go through life. You're not self-funding. It's not real free cash flow, even though it's added back on the cash flow statement. It's using your employees to finance your growth with equity. It's an equity financing, and so I don't even think it should be added back to the operating section of the cash flow statement. I think it's a financing cash flow. And so there's just a lot of things that have kept me on the sidelines when it comes to SaaS. I own a few of these personally, um, two or three, and they've pretty much done poorly for me. Maybe I'm just a bad picker when it comes to SaaS stocks. But I'll just the last thing I'll say, and then I'll turn it back to you is yeah, I've never been able to get there when it comes to SaaS. So when I was at the Motley Fool for almost 9 years, and the Motley Fool as a whole, I would say, are incredible software investors. They have built up a framework for investing in software, and so it's when I was there, at least, it was a very software centric um, sort of investing universe. I, however, was there for 9 years. I never covered one SaaS company by choice. We got to pick the companies that we covered, and all the analysts at the Motley Fool are judged um, based on this internal model portfolio software called Fool IQ, and we can manage our own portfolios, put our own stocks in there. We go long, short, if you want to, and we are judged based on three metrics: the performance of that model relative to the S&P 500, our accuracy ratio, which is basically a batting average. It's the number of our picks that outperform the market compared to the number that underperform, and then our information ratio, which is a measure of risk-adjusted returns that incorporate the Sharpe ratio. That model portfolio was implemented the year that I started at the Motley Fool, and so 2014. In all of the time that I managed that model portfolio, I never put one SaaS company in there, and so it's never been something that I could get on board with. That being said, the valuations have come in a lot. Goldman Sachs put out a chart recently that at the height of the SaaS boom, if you want to call it, they were trading at, well, enterprise value to sales of actually 20 times at one point on average. I think we're down to about 8 now, but they put out this chart on the forward PE, and at the peak it was 52 times they were trading at on forward PE. And look, I don't trust those earnings, first of all, because of the stock-based compensation and some other things. But now they're trading at 20 times forward PE. And so I actually think that for software investors, there's going to be a reversion to the mean, first of all, at some point. I don't know if we're there yet. But then also, I do think some of these companies are going to adapt, change some of these seat-based models, implement these agents, and they won't only survive, but they will thrive.
Man, that's a lot of good meat on the bone there, John. Just to recap a couple of the great points you made. And first of all, I want to give you some credit. Like we mentioned, you've been posting about this since 2022. This is a well-deserved victory lap, I think, that you get for calling out a lot of these things that the market was getting real excited about, perhaps overly excited about. Heather, can we show a couple more of John's tweets and posts that he's put out there? Kind of, John, here's one from 2024. But we can pick probably 20 of these if we wanted, John, about, just like you mentioned, some of the things that you were calling out that were potentially problematic. You mentioned 3 of them just in recent conversation here. You said the barriers to entry are low. There's really not a very deep moat, which is what Warren Buffett has conceptualized as a competitive advantage that keeps them insulated from others, and just the sheer number of competitors in this space. Those are all kind of problematic. And while it is good to go back and say, hey, we were right. Look at some of these. I like to point these out to show that you were on top of this. But I think bigger picture too, this is part of the investing process and the discipline of being a long-term investor who's looking to compound capital over years, if not decades, rather than just the short term. And I think that some of the things that we saw, especially with these software companies, as you correctly alluded to, were one, the valuations were getting way out of line. I remember when Zoom Video Communications, Zoom, a very simple company in many regards, was selling at 40 times sales, not 40 times earnings or cash flow, 40 times sales. And it really wasn't even generating hardly any profit. So extreme valuations, egregious, if you want to call it that. The
Simon,
stock-based oh yeah, go ahead, John.
sorry,
I'll go, please.
at that point in time, Zoom was growing at 300% a year.
Yep,
Okay.
yep.
And
We
it
had
was
to
being
COVID. Yeah,
it was
right.
being valued as if it was going to continue to grow at hundreds of percents a year for like 5 to 7 years. I did a reverse DCF using new constructs. I actually sat down with David Trainer in a meeting one-on-one, and we did some reverse DCFs for some of these companies. And Zoom was being priced as if it would have to maintain growth rates of over 100% for like 5 years at that time. And then beyond 5 years, it would have to grow for like 20% for like the next 15. It was insane. Some of these were insane. And that has nothing to
and
say
to point
about
out,
Zoom.
to time out on that, that's very, very difficult to do. Even saying 20% a year for 15 years might sound like it's achievable for a lot of people listening. That is incredibly hard, astronomically hard for a company to grow that quickly, compounding.
The S&P 500, if you look back over the last 20 and the last 30 years, the average earnings per share growth, bottom line, after all buybacks, all margin improvement, and all sales growth is incorporated, the average earnings per share growth compounded annually at the S&P 500 6.5%. 6.5%. Most recently, over the last 10 years, it has grown closer to 10%, Simon, because we've had a lot of accelerated growth in the last 10 years. But even at 10% EPS growth, that's not 300%.
Part two, I want to talk a little bit more in detail is the stock-based compensation angle, because I think this is dismissed or maybe lazy analysis in some instances. They're just saying, oh yeah, it's fine. You know, you're going out and diluting some shareholders. You're using that instead of cash to pay your employees. This was getting pretty egregious too for a while, John. I remember it kind of being the norm, or at least generally accepted by investors, for companies to pay out 20% of revenue as stock-based compensation to their top brass and to their employees. We cannot forget the impact of that is dilutive to the balance sheet, and it's not free. It's not like you're actually not paying anything when you're giving out stock. You're diluting your investors by doing that every time you do it.
Absolutely, you're diluting your investors. More importantly, I just think it's misleading. So, generally accepted accounting principles allow this to happen. So there's nothing wrong with what these companies are doing, and all companies do it. You add back stock-based compensation to the operating section of the cash flow statement. But it's clearly not an operating cash flow. It's an equity financing. It's a financing cash flow. Michael Mauboussin has written about this. So, you could argue, and he has argued, it should not be added back to the operating section of the cash flow statement. It's not an operating cash flow. You mentioned it got up to 20% of revenue. It was 100% at some companies of their operating cash flow. So meaning that one line item, stock-based compensation, on an operating cash flow statement accounted for 100% of the company's operating cash flow. In other words, they would have been operating cash flow negative without it. And then, of course, they would have been free cash flow negative without it as well. So I think it's misleading in how cash generative these businesses really are. But that's the other thing is these businesses weren't, we talked about once again, I could be wrong about this. I look right now, but I could be wrong. Lack of barriers to entry, lack of moats, bad corporate cultures with the stock-based compensation. But the big problem is they're not self-funding. They're not resilient. They're not profitable. They're not profitable, economically profitable and free cash flow generative businesses. At least back in 2022 when I started saying those things. Some of them, there are exceptions, have become profitable on a GAAP basis and on a free cash flow basis. And I applaud those companies.
So I want to fast forward. We've been talking about it in the recent past. Let's fast forward now to the current status quo of where we stand, John, because we did mention, there's kind of low barriers to entry. We talked about extreme egregious valuations. We talked about bad business practices with the stock-based compensation. I feel like a lot of those have corrected now back to the mean, at least here in 2026. It feels like you said, I believe the stat you said was 8 times enterprise value to sales versus 20 times just a few years ago. We're at a much more reasonable valuation for this sector. We know that a lot of these companies have unfortunately laid off a lot of employees. True, probably they overhired during the good times. We've certainly seen a lot of tech companies cutting jobs here within the last 12 months or so. And I think that a lot of that stock-based compensation has been reeled in as well, at least in a lot of the companies that I've seen. Where do you think that we stand right now? Where's the status quo of software companies? Is this the sector that is intriguing to invest in now because they've cured some of their previous ills? Or is this something you said you never invested in a single one in the past in your platform? Are you interested in software companies? Or you still staying far away because there's too many problems here?
So to be clear, at the Motley Fool, I never covered one, and I
Yep.
never put one into the model portfolio at the Motley Fool. Personally, I gambled on a few of these,
Yep.
and I own a few. Just to be clear about that. I, I'm trying to for my clients at Bastion Fiduciary. I'm trying to invest in companies that I think are, for the most part, beyond compare. So one of one. So if I'm going to give you an example that's not my portfolio because it's domestic only, but Taiwan Semiconductor, right? It's not in the portfolio. I do own it personally because I manage a domestic portfolio, but it's one of one. It currently manufactures maybe 60% of all the chips in the world and 95% of the advanced AI chips in the world. It's one of one. It's an earned monopoly. ASML is an earned monopoly. There's no competition. And I would say that for the most part, I'm trying to find companies that are either these monopolies or they operate in global oligopolies, and they only have a handful of competitors. Software to me doesn't fit that. And so while I do think that it's more attractively valued than it has been in 3 years, and maybe in 10 years, software as a whole, enterprise software as a whole, and I do think that we're going to get some sort of reversion to the mean. And I think, at some point soon, it's going to be a very good time to invest in software if you're a software investor. But I'm not just going for a return to the mean or some sort of valuation. I don't buy anything just because I think there's some sort of valuation discount. I'm a quality first investor, business and management quality first, and the way that I look at it, they don't meet those standards, and there's too much competition. So just really quickly, I was pitched one time in a 2-year period, let's say 18 months, 24 months, Airtable, Smartsheets, Asana, and Monday.com. They all do virtually the same thing, productivity software. But there's another 24 out there, Simon. There's another 24 out there. In human resources management, not only do ADP and Paychex now have very good SaaS platforms of their own, as does Intuit, right? But now you've got Paycom, Paylocity, Paycor, Namely, Gusto, Bamboo, Workday, Rippling. I mean, I could go on and on. There's 36 of these.
A zillion of them, yep.
A gazillion. Because there's no barriers to entry. And so I just think there's too much competition for the way I like to live. I like to sleep well I mean, I don't want to have to worry about an upstart coming in and taking share really quickly. I read a Capital Group note one time that said disruption. It was a great definition of disruption. Disruption is when an incumbent can come in and take market share for as far as the eye can see. Every year, a new entrant can come in and take market share from an incumbent every year for as long as the eye can see. I try to avoid that. I try to avoid new entrants coming in and messing up with my sleep.
John, we're going to jump into your wheelhouse in a moment here. We're going to talk about manufacturing, the industrial sector. You just mentioned, the portfolio manager work that you're doing at Bastion. I know that's exactly what you like to look at. I do want to talk about it in a moment. We actually got a question live from the audience here. Manoj asks, thanks for doing this. He says, what are your thoughts on Constellation Software? Perhaps a little blend of the two right there, right? This is a software company, which we just talked about in detail, but this is also and highly acquisitive company, very good returns. Kind of had that long-term structure of acquisitions that Mark Leonard was spearheading as a longtime CEO who recently stepped down. But I know that you've covered Constellation at least tangentially, John. You have any questions or thoughts? About Constellation?
Simon, I don't know if you're going to remember this, but
I think I will. Go ahead. I think I know where you're going. Go ahead.
The first company I ever pitched at the Motley Fool when I was going through the analyst development program was Constellation Software.
I do remember that, actually.
So at the time, and you read it, and sort of gave me feedback on it because you were on the rule breaker team at the time. And so when I was going through the analyst development program at the Motley Fool, which is a great program, at the time, we had to do pitches to like our three main services. And so we had to do a small cap pitch for hidden gems. We had to do a stock advisor pitch, and then we had to do a rule breaker pitch. And Constellation Software was my rule breaker pitch. And you read it, and you gave me the feedback, and I'll never forget that. Thank you.
I do remember this. I was wondering if that was the story you're going to go with. Keep going, John.
Yeah, and the other cool part about that story is, Mark Leonard, who we'll get to in a second, is the founder, and he was the CEO for a long time. And he is sort of notoriously private and doesn't do interviews. Well, for that pitch, I did an hour phone conversation with Mark Leonard, because I think he wanted to help out like a student, like sort of someone going through an investing development program. So I reached out to the company, and it made its way to Mark, and I had an hour-long phone conversation with Mark Leonard. And over the years, we haven't emailed in, maybe the last 4 or 5 years. But for several years after that, we would share a couple of emails every year. It was really cool that I got to build this sort of relationship with Mark Leonard, who's one of the CEOs that I admire most in this world. He's up there on the Mount Rushmore. I'm not going to get too specific into Constellation Software because I don't own it in the Bastion portfolio, but I'll say a few things. I will say one is, I think it's an incredible business. And I will say companies that excel at acquisitions, and they're very few, they're very, very few in my opinion, but companies that have built this internal acquisition platform almost have unbounded growth, Simon. Like companies that are driven by long-term secular tailwinds can grow at above average rates for a long period of time, but not forever. But companies that have a acquisition platform that have turned into this acquisition machine and it's become part of their corporate DNA, okay? And they're operating in a highly fragmented industry. So if you have both of those qualities, you've built up that muscle better than anybody else. You have that platform machine in your DNA, and you operate in a fragmented industry where there's not just hundreds, but thousands of competitors that you could buy and integrate. Your growth is almost unbounded when it comes to that. Not the rate of growth, but the duration of the growth. And so in that way, Constellation Software stands out to me personally as one of these companies that you can't model it in a DCF because it could be growing at above average rates, not just 5 years down the road, not just 10 years down the road, but as long as that culture is in place. Now, the company is being tested for the first time ever because Mark Leonard is no longer the CEO. We like to think, and I think at this point in time, that the gentleman that took over is, fully ingrained in that culture. And Mark, as you know, Simon, and your listeners probably know, Mark wasn't doing all the acquisitions himself. This was a machine that they built across the company. And so I think the company is being tested for the first time with Mark not there. And the stock is obviously, it's its largest drawdown in its history. Believe it or not, Simon, up until now, Constellation Software had never had, I think, even a 30% drawdown. It was insane. I mean, even Berkshire Hathaway had 350% drawdown in its history. I don't think until now, this drawdown, I don't think it had ever had a 30% drawdown. So it's being tested for the first time, and Mark's not there to lead it. But if it's a company that I admire deeply.
Is Warren Buffett also on Mount Rushmore of the greatest investors for you there, John?
Yeah, oh, definitely.
Okay,
He's definitely one of the greatest investors of all time, and also one of the greatest businessmen of all time.
That
I think
methodical.
Druckenmiller is probably the the best, like, pure investor of all time, in my opinion. He wasn't doing the business things that Buffett was doing. He wasn't building the holding company. He didn't own 100 different, businesses under that holding company. I think Druck's probably the best investor of all time. If you look at just the numbers, 30% annualized over 30 years with no down year ever. But Buffett is definitely one of the greatest investors of all time, in my opinion.
I think it makes a good case that when you have Buffett and you've got Mark Leonard that are right there on Mount Rushmore, that good investors can also be good CEOs of companies with that methodical acquisition strategy. Works very well.
Definitely.
Um, Another fun story, since you told one, I've got one for you too, John, which is there were many Saturdays at our previous employer that I would go in bright and early in the morning, and there would be no one else in the entire office. I'd go in to get some work done, except there was always one person who was there before me on Saturday mornings, and it was John Rotonti, the early riser, who was always there, just as dedicated to his craft as I am. I think that's
I
why I
used
enjoy chatting with you so much. We and I look at different perspectives, I think, on the market, but every time you're talking, I'm listening. And
I
I
used to
want to
love
hear
those
your.
Saturdays. We used to love our chats on those
It
Saturdays.
was. Those were good mornings. I want to talk about your wheelhouse now, John, because like you mentioned, portfolio manager at Bastion Fiduciary, you are covering, if I have this correctly, the industrials and manufacturing sector right now. And a lot of the things that you just mentioned in this conversation, quality first, duration of growth, wide moats, I think that a lot of those are probably inherent in a lot of the companies that you're investing in. But what are you seeing in the industrial space right now? I know this is kind of a hotter topic these days as we're kind of getting out of these higher risk, kind of software companies. You want to have a moat, you want to have some durability. What's your take on the status quo of industrials in America?
Yeah, so I manage an industrial and infrastructure portfolio, and in manufacturing clearly falls under that. Um, eh, I would say, though, that I have a very broad and loose definition of industrials and infrastructure, and so I think of it as more of a generalist portfolio, um, rather than a strict vertical portfolio. But yes, I do follow industrials and manufacturing and broader infrastructure very closely. As far as where we stand right now, I think that in the US, we've been in a 3+ year industrial recession. Um, and so the first data point we would look at, Simon, would be the ISM PMI manufacturing index. And it has been um, in contraction below that 50 level, for over 3 years. It hit 50 only 3 times in the past 3 years, and recently a fourth, but I'll go through them. So in March of 2024, it hit 50 for 1 month. March of 2024. So let me take a step back, Simon. It first turned down below 50 in November of 2022. So let's go back. November of 2022 is when this industrial manufacturing recession started in the US, November of 2022. It was up and then was down, 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 down. It went up for 1 month in March of 2024. That was the first time it was up. But then every other month in 2024, it was below 50. And then in January and February of 2025, it was slightly above 50 just for those 2 months. And then it was down below 50 for every other month of 2025. So in over a 3-year period, it was only above 50 3 times until January of 2026. So this is the fourth time. And it wasn't just 50 or 51. It jumped all the way to 52.6, Simon. And according to Bespoke on X, that's the second highest month-over-month jump in the last 30 years. So that's one data point.
Holy cow.
Yeah. One data point suggesting that maybe we're troughing here. I'm going to give you several. So let's move on to manufacturing employment. So manufacturing non-farm payrolls just posted their second monthly net increase in the last 2 years. Only the second increase, monthly increase in the last 2 years. Trucking is a big part of our industrial economy here in the U.S. I think 70% of industrial goods actually move by truck in this country. Well, Craig Fuller, he runs Freight Alley. I recommend everyone follow him on X. I don't know the guy, but if you want to understand the manufacturing industrial economy, follow him. He runs Freight Alley. extremely knowledgeable on trucking and broader industrials. On February 7th, he just posted that trucking volumes are surging, his language, and that quote unquote manufacturing is coming back, end quote. You know, the Trump White House has a website that lists all the announced investments into the US, both domestic and foreign investments. And that includes things like Apple 600 billion, Stargate's 500 billion, Taiwan Semiconductors 100 billion, Saudi 600 billion, UAE 1.4 trillion, Simon. Well, that total number right now sits at $9.6 trillion on the White House website of announced investments. Eaton, which is a company we own in the Bastion portfolio I manage, they are tracking $2.6 trillion of announced mega projects in the US. And interestingly, that's 29% higher than in 2024. And only 15% of those projects have broken ground. So hopefully there's a long duration of growth ahead here. And so those data points, but what gives me more conviction that maybe we're troughing, maybe we're coming out of this 3+ year industrial recession in the US, is company commentary on earnings calls this most recent earnings season. So we own Amphenol and TE Connectivity in the portfolio that I manage, and both of those companies said that they're seeing a broadening of industrial demand, almost using the same language, broadening of industrial demand globally, Simon, globally, especially even in Europe, which has just been in a complete malaise, industrial malaise. Trane is another company we own, Trane Technologies in the Bastion portfolio I mentioned. And a lot of people think, Trane is a residential HVAC brand, but only 20% of its sales actually come from residential air conditioning and heating. It actually has a transportation segment, refrigerated transportation, called Thermo King, which is the largest in the world. But then like 70% of its business, 70% of its sales come from selling commercial HVAC. And in commercial, which is 70% of their sales, they sell into 14 different verticals. So you could think like healthcare being one and universities being one. AI is one. AI factories, AI data centers is one of 14 verticals that it sells into the commercial end market. And it said on its most recent earning call that it had growth in 12 of those 14 commercial end markets, which is more than it's had in the recent past. So a lot of my companies are telling me through these earnings calls that we are seeing some sort, fingers crossed, of a bottom when it comes to the industrial economy in the U.S.
John, I've got to assume one of the drivers of this is AI data center infrastructure, right? We talked here recently about how expensive it is to construct a data center. Here's a graphic. Thank you, Heather, for pulling this one up. But just how much it's costing now. $40 billion kind of at the low end of building a modern AI data center. You mentioned several of the companies that play a role in that. Trane Technologies, certainly one of them. Something like a Schneider Electric, the powering of it, the cooling of it, all the associated infrastructure from this. OpenAI has now got $1.5 trillion of planned CapEx, not only for its own balance sheet, but for its partners, that's going to go towards data centers. Is this for real, John? You're much closer to this space than I am. Are we going to get to the same things that are being broadcast in the press releases in terms of the magnitude of this? Or how do you view AI infrastructure in the coming years?
Yeah, I mean, so just to use, you mentioned the OpenAI 1.4 trillion. So they announced that across 30 gigawatts. So if you just divide that, that's 46 trillion per gigawatt, which is the number that you just said, 40 trillion. Yep. So that's 46 trillion per gigawatt based on what OpenAI has put out into the world, the announcements they've made. Look, Jensen has said that he thinks there's going to be Jensen Huang, CEO of Nvidia, and let's be honest, Jensen is the architect of this AI build out around the world. He's the architect of it. He's not only architecting the chips, the GPUs that go into these data centers, but he's architecting the cadence which is now a yearly cadence, which means every other major player in that supply chain now is updating their stuff on a yearly cadence to keep up with Nvidia's new server racks. And he has said 3 to 4 trillion through 2030, and at this point, that's the number that I'm going off of because he's the architect. OpenAI, that announcement's half of that. That's 1.5 trillion just from OpenAI. Now, I'm not saying all of it will come to fruition, but right now the number I'm using is 3 to 4 trillion because that's the number Jensen has put out. In his most recent interview on CNBC last week, he actually went beyond 2030. He said that he expects the AI build out to last, the quote was another 7 or 8 years. So he's actually now extended that beyond 2030. And so the way that I think about it right now, Simon, is 3 to 4 trillion in AI factory build out through 2030, and then another 1 trillion on top of that in electrical grid upgrades and build out. So, we're looking at about 5 trillion probably based on, my sort of base case.
That is a lot of pocket change and quarters to pick up from the cushions of the couch. $3 trillion through 2030. A reminder that this is certainly going to benefit companies like the Nvidias and the AMDs and the chip makers out there, but the infrastructure as well, the supporting infrastructure, a lot of that which is supply constrained right now in the best possible way for these companies who are not as expensive as a lot of those software names or a lot of those chip companies. John mentioned 3 of them. Trane Technologies is TT, the ticker on that one, Amphenol, APH, and then TE Connectivity, TEL. I'm going to open this up to a question or two. Heather, we got one from Anaj from the audience earlier. Do you have a question that you would like to ask John as we wrap up the program about software, about AI, about infrastructure, or any of the topics we just went over?
Hello, there we are. First, what a delightful conversation. It's been really fascinating.
Thank you.
Bringing it all together, do you think the way you're talking about software as a service and how the there's like no moat, how everything was kind of overblown and how it was kind of a problematic investment back, a couple years back. Do you think that's an issue in some of the new AI companies that we're seeing pop up now? Are there certain companies you're really seeing push AI, but there is no moat? Is
Thank
there
you for the
anything? Yeah.
No, great question. Thank you for the question. So just to reiterate, there's no moat based on the way that I look at things. I could be wrong. And there are exceptions. There are definitely some software companies that I think have moats, but they're few and far between based on the way that I look at things. And one other thing I want to say about software is there are companies that are vertically integrating software into their hardware. And I think that software component, when vertically integrated into the hardware and it becomes a software-driven hardware, the software actually becomes the biggest part of that moat. And so you look at something like CUDA at NVIDIA, which we also own in the strategy, right? Like CUDA is a big, big, big part of NVIDIA's moat, right? And you look at something like Arista Networks, which is a networking company, which is another stock that we own in the Bastion portfolio. Well, Arista's got its software that runs its networking equipment that runs and monitors and actually self-heals. It's got self-healing capabilities. All of Arista's routers and things like that, and switches. And so when you can combine hardware and software, Trane's another one. Trane has the leading HVAC software monitoring software in the world. When you can combine hardware and software, that really, in my opinion, strengthens the moat. As far as new AI companies and whether I think they have a moat, a lot of them are not public yet. And so I haven't done like a deep dive on them, although I do think we're going to be seeing maybe 2 of them come public this year in Anthropic and OpenAI. And then like the neo clouds, just not something I'm really interested in at this point. They're just renting GPU space. I don't see a whole lot of moat there. I think the biggest AI companies in the world at this point are the incumbents, to be honest with you. I think it's a company like Alphabet, which we own, or like
Mhm.
Microsoft, which we don't own, or like Amazon, which we own, when they have the full stack. When they have the full stack. And I think when you have the full stack like that, so by full stack, I mean you own the data centers, you own the chips that go in the data centers, um, you have this massive supply chain to populate those data centers. You own, in Alphabet's case, a leading model, if not the leading model, and then apps that sit on top of everything, to distribute the models to billions and billions and billions of people every day. And so a company like Alphabet, I think Alphabet's the widest moat AI company in the world at this point. I'm expecting good things from Amazon this year once they get some more capacity online for similar reasons. I mean, Amazon, they have the largest AI data center company in the world as far as footprint, as far as cloud footprint, and they have their own chips in Tranium, and they have largish ownership in Anthropic, but they also have this bedrock layer, where you can access almost any model in the world right through AWS. And then their logistics network. It's just, so I think of Alphabet as like the leading AI company in the world, and I think of Amazon as like the leading infrastructure logistics company in the world. And when you can do all of those things up and down the stack, that's kind of how I think about moats. And the other way I think about moats is like, just how adaptable is a company? Like, do they have a culture that is resilient and adaptable and always finds a way to remain relevant in a rapidly changing world, because this world is changing faster than we can imagine. I mean, if you look at this Anthropic chart that is up all over X right now, it's insane. I mean, 3 years ago, 0 revenue, and then 1 year after that, 100 million in revenues, and 1 year after that, $1 billion in revenues, and last 12 months, 14 billion. So its revenues
Orders
are
of
increasing.
magnitude every year. That's insane.
It's insane.
Yeah.
It's insane. And so in the very least, it shows adoption, right? In the very least, Simon, it shows adoption, at a very rapid pace. And so, yeah,
We
I want to find companies that remain, have figured out ways to thrive over 100 years in a lot of ways. I mean, if you look at, the Trane brand is over 100 years old.
Mhm.
Amphenol is 94 years old. TE Connectivity is 84 years old. Even Vertiv, which is an AI specific play that we own in the portfolio, that's a 60-year-old business, but they've been doing what they do now since their beginning. Vertiv was founded as a company that cools computer rooms 60 years ago. And what is a data center? It's a big ass computer room.
Those Blackwell chips from Nvidia, they run hot and they take a lot of power and they take a lot of liquid cooling, John. That's very true.
So yeah, these things run so hot, Simon. So the Nvidia H100s, they required 50 kilowatts power per rack, right? And then you go one generation more than that, the GB200s required 120 kilowatts per rack, up from 50 kilowatts the generation before. Well, these next gen Vera Rubin server rack systems that are really going to come online in 2026 this year, they run on 600 kilowatts.
Yeah.
So we were 50 kilowatts 2 generations ago. We jumped to 120 kilowatts. Vera Rubins are 600 kilowatts. The next generation is going to be 1 million kilowatts, probably by 2030. In 1 million kilowatts in a filing cabinet. And if you think about, so what does that do for liquid cooling, right? Something like, as you just said, like liquid cooling up until Vera Rubin was a nice to have. But now
Absolutely
liquid cooling is an undeniable must-have.
Mm-hmm.
And so now data centers are going to have to be built and designed not only around GPUs or the other accelerators, but around liquid cooling. It's an inflection point in the way these data centers are going to be designed. That's why companies like Del Oro Group, third-party technology sort of consulting business, they're estimating 30% CAGRs for liquid cooling going forward. So yeah, a flip has definitely switched. And so when you put more GPUs in a filing cabinet, in a rack, and then more racks in a data center, because these data centers are getting bigger and bigger. We haven't even built a lot of these 1 gigawatt ones yet, right? And so more chips per rack, more racks per data center, and then more data centers, right? Because we're gonna probably bring on 100 gigawatts by 2030. So what do you need for that? Not only more liquid cooling, but more electrical components, more interconnects from an Amphenol or a TE connectivity, more networking from like an Arista, because so there's scale up, which is connecting the chips up that rack. You have to network those chips. There's scale out, which is networking the racks to each other. And then there's scale across, which is networking the data centers to each other. And so, like you said, there's a shortage. Everyone's talking about the shortage in memory and optics, fiber optics. They're sort of anticipating a shortage, but there's obviously a huge huge shortage in memory. But there's a shortage in, the biggest shortage is power, as we all know. The biggest bottleneck is power. I think the second biggest shortage is people, electrical engineers. It takes like 3 or 4 years of training to be able to do this medium voltage stuff you need inside a data center. And that's why robots are such a big deal. Jensen, but also Elon Musk talking about $50 trillion in physical AI over time. $50 trillion TAM in physical AI. And some of that's robots. If you think of why you need robots, we don't have any people. So we can't offshore labor at low cost anymore because we're onshoring everything. There's been a mind shift towards onshoring. So we're no longer going to have the low cost offshore labor to the extent we did. The baby boomers are retiring, and we have immigration restrictions. So our labor force is shrinking, and no one wants to train to be an electrical engineer anymore. I don't want to say no one, but like
I do, John. I think you add 2 zeros to your current salary if you take any one of those jobs
Simon.
right now.
But like if you want to work for like a utility grid operator, and a lot of people don't want to climb the high poles. I'm not talking about the poles you see like running down Main Street or outside your house. I'm talking about long distance transmission lines.
Yeah.
Right? Like people don't want to get up on those high poles anymore. That's by the way, that's a 10-year apprenticeship. And so we just have a shortage of electrical engineers. We have a shortage of plumbers. We have a shortage of skills tradesmen. That's why this other company we own, Quanta, ticker PWR, they bought a trade school. Like, they don't mess around. They bought a university back in 2018 because they saw the shortage of labor problem. So if you want to, if we as the U.S., which we do, this administration definitely does, if you want to be the leader in AI and you want to beat China, and if you think we're in an existential threat of losing to China, and if you want to usher in a fourth industrial revolution, which it seems like they do, not only with tariffs but with OBA and with some of other policies. If you want to usher in a fourth industrial revolution, you're gonna have to have more electrical grid. You're gonna have to have more power. So power, labor, and then we have a shortage of networking. Like I said, scale up, scale out, and scale across. We have a shortage of a lot of stuff is capacity constrained, and so I'm
John,
excited by the duration of the build out. The rate at which the stuff is growing is right now, it's mind-boggling. We talked about 3 or 4 trillion by 2030. The hyperscalers are going to, in the U.S. alone, are going to they're going to spend 650 billion this year. 650 billion. That's going to go up to about 750 billion next year, most likely. We're not too far from 3 trillion right now, dude.
It's going to get there. John, we're wrapping up. I want to get to 2 more questions, lightning round style on this one. Heather, I saw you posted one of them up here. I want to make sure we address the audience questions. Here's the first one. Go ahead, Heather.
From Mr. Jamley88. Do you see the growing national debt as a threat to the re-industrialization?
I think it's a threat to more than the reindustrialization. Yes, I think it's one of the biggest risks facing our country.
And a lot of this CapEx John was just talking about is actually on the corporate balance sheets, not on America's balance sheet, which is a good point to make as well.
Yes, thank you.
All right. And then from at Stocks Current, we are building $1 to $5 trillion on AI infrastructure. 4 to what? It must need to build AI software and applications on top at least 5x to 10x at least. What are your thoughts?
Absolutely, we need applications. There's no question about that. Yeah, thank you for that. Yeah, and so I mentioned Alphabet. They have 8 applications right now with over, what is it, 2 billion daily users or 2 billion users, whatever it is. May not be daily, monthly users. And we're going to get new applications from existing SaaS companies. Like I said, I strongly believe that some of these enterprise software companies are going to use AI to adapt, not only to survive but to thrive, especially when we talk about agentic AI. And so, yeah, I think the new apps are going to come not only from existing software companies and from incumbent hyperscalers, but from some upstarts as well. Absolutely, I agree with that.
All right. And they also had a part 2 from at Stocks Current. If we fail to build AI applications or softwares at that scale, isn't that a risk to AI infrastructure, which you just said?
Absolutely. I'm not arguing to not build software. Absolutely not arguing that. Great point.
Those are fantastic. I think we should, John, I feel like you and I could continue this for another couple of hours. This is a 10 beer conversation. Normally a 2 beer conversation is a good one. This is a 10 beer conversation. We're going to have you back, my friend, on the show again. This was a lot of fun chatting with you today. Thanks again for being part of the 7 Investing live stream this morning.
Thank you for having me, and I'd love to come back and have those other 8 beer conversations.
You got it, John. So if you want to follow along with John, he is a, like we said, portfolio manager at Bastion Fiduciary. That's bastion.com if you want to learn more about him, or at let's see, let me make sure I get this right, at jrogrow on Twitter if you want to follow along with your X handle. John, a fantastic conversation with you as always. Really appreciate you being on the show, and we're looking forward to following a lot of your coverage and also the stocks you're selecting for your portfolios in the industrial markets. We'll call it at that. Thank you again for everyone who's tuning in to today's show here on Monday the 16th. We're going to be coming back on Wednesday's show on the 18th and featuring Nick and Casey Rossalillo. They are the founders of Chipstock Investor. We're going to be talking about kind of this 2-horse race between Nvidia and AMD on creating the most cutting edge and highest performance GPUs to power the AI data center. So looking forward to coming back to you again on Wednesday. I appreciate you tuning in for this show. In the meantime, be safe and be kind to one another. Have a great day.
Thank you, Simon. Thank you, Heather. Thanks, you guests.